In this video, I'm going to give you 5 simple entry procedures that will help you enter the market with confidence and give you a stable, mathematically backed structure to trade off of. And stick around for number 5, because if you are trading this setup, you may want to rethink it. Now, this is a supply and demand hierarchy. We have extreme supply, our midpoint, demand, and extreme demand. And how did we create this? We took the price action from the previous day, the high and the low, and I used this Gann tool here that I just modified to divide perfectly into 5. Here are the settings for that. We've drawn from the previous day's high and low, and we trade it the next day. And you can see here, there is already a very obvious entry that occurred on February the 19th for a trade short off of our extreme supply down to the extreme demand. And why do we trade from the extreme supply to the extreme demand? Simply because that offers us the best risk to reward that we can get. Now let's get into the first entry procedure that I'm going to show you. Number 1, feed and break. So a feed and break is where price moves into our zone, the price stalls, and then reverses. And we trade this off of extreme supply or extreme demand in the internal structure of these zones. So you can see here that this candle has broken in to our zone. Let's play this out one candle at a time so you know exactly what you're doing. And now price action is just spending a lot of time in the zone. It's stalling at this point. Okay, and now we have broken down and the candle has clearly closed back outside of the zone. Now that is our entry point to go short. If we let this short play out, and as you can see, price clearly moves down to our target, which is the low of the previous day. Now let's get into the second example, a feed, sweep and break. Very similar to the first example, but with one little addition. So we are waiting for price to come down into this zone, spend a little time here, take out the previous day's low, come back up, close in the internal structure of our supply and demand zones, and then go long for a trade. And I'll show you exactly how this plays out, one candle at a time. So we feed in, price is stalling, and this candle here has just taken out the previous day's low. Great. Again, taking that low out, spending a little bit of time here, signs of price stalling are clear. But we don't just enter now, we wait for our confirmation candle. Okay, and price is just pushing back down again. And again, we've taken out the low from the previous day's price action. Now, one candle at a time, here we go. And you see that aggressive candle is closed back into the internal structure of our zones for a trade long. And let's just see how this plays out. And of course, the momentum is strong in this trade. And you can't tell me that this trade here is not clearly the move of the day, especially when it lines up with the New York Open. You're in this trade for half an hour for a 3.63 risk to reward ratio. And this was only on the 20th of February, very recent price action. Example number 3, rejections. Let's zoom in a touch here. So you can see this little candle here has just clearly rejected off our zone, right? But we don't enter yet. This is just confirmation number 1 of these types of setups. Now, rejections are a sequence of 2 to 3 candles, no more, no less. The momentum of price has clearly rejected this zone, which just is representing a lot of people buying into the market at that point. And now we wait for a confirmation candle. And we have it. This candle needs to break. The body of it here needs to break this previous candle. And you can see it just closed below it and took out that candle. And now we are in a rejection. So what can also happen with rejections is you can have, say you have this candle here, and then you can have a stalling candle in between, and then you end up with your close. Okay, so that can happen. So between 2 and 3 candles. Let's just see how this plays out roughly. Right, and again, you can't tell me that that is not the moment to enter in the market. Look at the price action so far. Ranging. You enter here and immediately price rejects off of that area. Another clear reason why this mathematical framework of the supply and demand hierarchy works. It's maths based. It's not done by eye. It's not guessing. Example number 4, continuation. Now, this is where price breaks outside the structure of a supply and demand hierarchy, rejects off of it, and then we enter a trade. So it looks something like this. Price would come down, price would clearly reject off of this area here, and then we'd enter a trade here, trading outside of the zones. All we're looking for is this. Let's speed up the tape. We have closed outside of the zone. Confirmation number 1. We want it to reject off. Confirmation number 2, a rejection off of the zone just here. Confirmation number 3 is now a close in the momentum that we're trading, and that will be a red candle because we are trading short. Here we go. There is our entry. Very simple. Now let's just play this out just quickly to see what happens. Yeah, and you can see, bang, straight into profit. And again, look at this zone. Ranging. Moment we enter the market here, bang, clearly the move of the day. This one I don't recommend trading, but I will show you this example so that you can avoid it and save yourself some money. For a breakout to occur, we need to have either come from the internal zone or closed back from outside into the internal zone and then close outside of the zone for a breakout. And it's just a straight entry. There's no rejection off the top here. All that happens is price will come from the internal zone and close outside quite aggressively. The reason I don't recommend trading these is because they give you a terrible risk to reward ratio. And quite often what happens is you'll see that the breakout occurs. All it does is sweep the high or the low of the day before, feeds back in the zone, closes down, and then you've got me here just shorting the shit out of this right here in a profitable trade. This is a profitable example of a breakout I'll show you now. Price is in the internal zone and we're waiting for it to shift outside of the zone. Breakout is a very, very simple and classic way to trade, but it's not a great way to trade. Okay, and you see price breaks out of the zone very aggressively here. And you see that as the entry point, very simple, classic way of trading. And you can see price does go up. And that's great, you know, a 1.3 or whatever, right? But if you noted the risk to reward on the other trades, they are far higher and far greater. So breakouts are a risky way to trade and I don't recommend them. If you do want to learn how to take profits out of the market like a professional, then watch this video here. If you do need a little bit of help with your trading, check out the links in the description below and I'll see you in the next video.